In an unsettled world buffeted by contradictory economic crosscurrents, there are few islands of analytical sobriety left. But this week we heard from one of them, Tiff Macklem, the low-key and courtly governor of the Bank of Canada. While other central banks anxiously pause or continue raising rates amid the inflation fever, Macklem and his governing council courageously broke the hawk ranks and cut Canada's benchmark interest rate to 4.75%. It was a move born of intellectual honesty and clear-eyed realism about what their $2 trillion economy needs. "We've come a long way in the fight against inflation," Macklem soberly intoned, in the ponderous baritone of a man conscious that his words could move markets. And indeed, the Canadian dollar dipped on the news as rate cut expectations were ratified. But Macklem's credibility, forged over decades as a technocratic monetary policy shaman, shone through. You got the sense of a man unbound by political restraints or narcissistic policy blurtings. Just a relentless focus on the wise management of the nation's economic affairs. After all, Canada's inflation rate has fallen to a very manageable 2.7% after peaking well above 8% last year. The federated parliamentary democracy of 38 million showed remarkable solidarity in absorbing those biting rate hikes that Macklem was compelled to inflict. Unemployment has ticked up to 6.1%, no catastrophe, but a sign the monetary brakes had begun to bind too tightly on growth. Meanwhile, March's 1.7% annualized GDP print confirmed the economic softening that gave Macklem's team impetus to join the global rate cut cavalcade. For Canada is an upstanding member of the liberal democratic order, and cannot afford to remain too hawkish compared to U.S. monetary policy and the other G7 powers. There are limits to how far we can diverge from the United States, Macklem noted, in a rare flash of strategically blunt insight. That impulse toward policy convergence with the indispensable nation to the south rang through. For what the Bank of Canada does echoes into corporate boardrooms across this vast nation of foresters, fishers, miners, frackers, manufacturers, the muscular economic dynamos powering Canada's prosperity. And even as traders began dissecting Macklem's every syllable for clues about future cuts, the governor urged patience. "Let's just enjoy the moment a bit," he deflected, unwilling to indulge the fevered handicapping that passes for modern financial analysis. One could imagine him repairing after the press conference to his bookline study, pouring a fingerweight of 20-year-old Canadian rye and reclining with a battered Dostoevsky novel. A brief respite before the cyclical madness begins anew. For above all else, Macklem radiates a sense of cyclical equanimity and awareness that no matter how heated the inflation/growth/deglobalization debates become, monetary policy must adjust and the economic zephyrs will eventually blow the other way once more. Steadiness personified, in a world too often ricocheting between dismay, fanaticism and giddiness. Macklem is unflappable ballast, an anchor of granite-faced probity. His calm guidance will be especially needful in the months ahead. Inflation may potentially be higher if global tensions escalate, if house prices in Canada rise faster than expected, or if wage growth remains high relative to productivity, as he warned.